maybe I'll just start with introducing Andrei. Andrei, thank you so much for being with us. Everybody, welcome. Good afternoon. It's 2 minutes past 12, so I can say good afternoon. We're very, very pleased to welcome Professor Andrei Badescu from the University of Toronto today for a very interesting talk. So Andrei, thank you so much for being with us, and I think we can get started in just 2 minutes. I'll over to you, Andrei. Thank you.
Thanks, Johnny. Okay, so well, I'm happy to be able to deliver a talk. Sadly, it didn't work in person. Hopefully next time. And yeah, I'm really looking to meet the entire crew there and students and everyone. So today I'm going to talk about some work that I did together with my colleague Sheldon Lin and a few of our students, current students, Samson and Sophia, and one of our past student, sorry, not Samson, Spark and Sophia, and one of our past student, Samson, who is a professor at Georgia Tech right now. So in the last few years, we work on some family of distributions called mixture of experts, or a subclass of mixture of experts, with various applications in non-life insurance in both rate making and claim reserving. So today's talk is going to be based on a few papers that we co-authored in the last few years, and mostly I'm going to try to emphasize on one of the latest work that appeared in the journals of RISC and insurance that consider this class of mixture of experts equipped with random effects. And I'm going to show some sort of application for rate making and risk classification. Here is our website, so you can go there if you're interested in looking at the work that we did in the last few years, and you can download the papers from there. I'm going to attach at the end of the presentation a list of the publications we use for this. And if you guys are interested and you have further questions at the end or later on, just feel free to email me or Sheldon or to any of our students. You have all the email addresses at that website, on that website. So I'm going to start with the outline of the talk. And in the beginning, I'm going to talk a little bit in general about what questions we're trying to address in non-life insurance. Mainly, I'm going to focus on rate making, but this family of distributions that we're proposing can be very useful to be applied and to tackle problems in claim reserving as well. So I'm going to talk about a modeling perspective in actuarial science. And then I'm going to introduce this class of mixture of experts that is pretty used right now in machine learning. And I'm going to assume a certain subclass of this more general family of distribution mixture of experts. I'm going to use and introduce you to the so-called logit-weighted reduced mixture of experts that has certain assumptions that simplify, so makes the distribution a subclass of the more general mixture of experts. And I'm going to show how, well, I'm going to discuss how we use it in some of the rate making applications. And then I'm going to generalize it by adding random effects, and we're going to look at an application that considers a posterior modeling. So we'll be interested in keeping track of the past history of policyholders and predicting number or amount of claims in the future. And I'm going to present a real data application. So we collaborated with an insurance company, and I'm going to talk about the real data application, and I'm going to show you some results and compare some of the classical benchmark models that are used in insurance with the ones that we propose, and comment on differences. So I'm going to start with a very general setup that we've seen. It's a statistical setup that we've seen and well, occurs everywhere in P&C, both in rate making and claim reserving. So let's assume that we have a portfolio of policyholders, and we're trying to model some sort of a response. And here we have a vector of responses y. So potentially we may be interested in modeling a multivariate response, like let's say number of claims that a certain portfolio has in various lines of business, or aggregate claims, or so we can both model frequency and severity random variables. But these are the responses, and what we are also observing, we're observing the policyholder information that I'm going to assume that we have p covariates, and they are all recorded in a vector of covariates denoted by x here. So usually when we have the data in insurance, we're dealing with these two multivariate responses y and the covariates x, and we're trying to propose a modeling framework for either stochastic claim reserving or for rate making. And when we talk about modeling framework, we have to make certain distributions assumptions. So, well, most of the time, the people are assuming certain parametric distributions on the number of claims, on the claim sizes, and so on. We have to make assumptions on the dependent structures, let's say, that exist between different lines of business, if we are interested, again, in modeling a multivariate response. We have to make certain assumptions on regression patterns, right, like GLM or GAM or any sort of statistical model that is used. So in general, we have to make a modeling framework assumption, and then we are trying to calibrate the model. And then we are interested in coming up with a predictive distribution. Most of the times, or sometimes, you are interested in obtaining like just point estimators, but ideally you will need the entire distribution of your response y, right? And assuming that you have newcomers or old comers, they're renewing their policies, we are trying to make predictions with respect to the number of claims, claim sizes, and so on, based on the history, and we try to predict in the future premiums, or we try to calculate reserves in the future. So this is a very general setup that we're working with in non-life insurance. And again, this is a statistical setup, so it appears in a lot of other areas, right? Now, without having a very exhaustive characterization of different types of modeling approaches, I put here three types, and I call the parametric models, machine learning models, and mixture-based models. So the parametric models, I'm sure you are familiar with, the GLM or the GAM or copula type models. They have nice properties. They are very easy, well, not very, but most of the times they are easier to interpret. They are easy to compute, to calibrate the model on your data. Sometimes we're dealing with inflexibility of catching the real character of the data, due to the fact that sometimes we're forced to use certain dependence assumptions or linear assumptions, like the GLM assumes linear dependency and so on. So sometimes we will not be able, depending what models we're assuming, we will not be able to catch up the complexity of a data set. Then we have the machine learning methods, models that are used more and more extensively, like decision tree neural networks and so on. They are more flexible sometimes, and well, most of the times they're harder to interpret. So sometimes may be problematic to explain to the policyholders why the premium change, right? Because you're going to have a point estimator for the premium, and that is not easy always to be interpreted. And then sometimes you have overfitting problems, and hence not robust. They're not always robust. And I have here a third class of approaches that I call the mixture-based approaches, which the mixture-based approach is a semi-parametric type of model. So we're going to have the number of components in our mixture is going to be something that we have to determine from the data. Usually these mixture-based models are interpretable. So I'm going to explain to you, and They have this nice property of interpretability. You can assume that you have a portfolio of policyholders, and then you assume different latent states that may correspond to risks classification, to different risks within that portfolio. So these models may be interpretable. And they're pretty flexible, as you will see. And we said that they are data driven. So technically, you can fit any sort of data that you have, independent on how complicated the data is, and assuming that you use a model, a mixture-based model that has nice property like denseness and so on, closeness properties and so on, you can guarantee, at least theoretically, that you can catch the whatever happens in the data. So from a modeling, from an actuarial perspective, what we want when we have to propose a model, we want a model that is flexible and is able to accommodate a big data. Like ideally in insurance, you're dealing with a lot of covariates, right? So you have to be able to have a model and that is going to be like it's appropriate to be used on a big data set. You want a model that can fit heavy tail data. Like we all know that in insurance, you deal with a lot of like heavy tails with multi-modality. And again, you have to model different dependent structures. And rather than assuming a certain dependent structure and hoping that the data follows that dependent structure, it will be ideal to have a model that fits any sort of dependent structure, right? And we hope that this multi-variate model that we are proposing, and we actually show that it works, and it has certain statistical properties that makes it ideal to accommodate any dependent structure without making actually an assumption directly on the dependent structure. Another property, as I said, interpretability, and ideally you will need a high predictive power. And finally, obviously, one of the most important things is that you need to be able to derive very effective estimation algorithms that are computational tractable in a short time, ideally, and your model is able to handle very big data. And usually the insurance companies are dealing with very large portfolios, and more importantly, those portfolios are very heterogeneous, right? So we have to deal with the heterogeneity of the data in insurance. Trying to answer all these questions, in 2019, we proposed, so we look at this class of mixture of experts, which again is used a lot nowadays in machine learning, in the machine learning literature. What this class is like the structure of this class. So technically, you're trying to model this response Y, right, for the highest policyholder. F represents the density of this multivariate response that depends on your covariates that are quantified in this vector xi and some parameter described in this vector psi. So technically, you have a combination between some weights denoted by pi sub j. So you have G latent states that eventually may be interpreted, and that's one of the nice properties of this class of distributions. So you have G different classes of risk, and each policyholder will have a certain probability to belong to one of those classes. And once you are in one of the classes, you have a density here, F denoted by F, that technically describes the riskiness associated to that particular class. So it can be a discrete if you are modeling a discrete response like frequency, or it may be a continuous random variable if you're modeling a claim size, or it can be a mix between these two. Now, the general class of mixture of experts actually assumes that both these these probability vectors, which are called gating functions, they depend on some covariates. So they depend on the covariates of each policyholder. So technically, the probability to be assigned to one of these risk classes is going to be completely dependent on the covariates of each policyholders. And once you are there, the claim sizes or the claim frequency are going to also be dependent on the covariates. Here you don't see the covariates, but the general class of mixture of experts assume also regression in the experts. So these densities Fs are called the expert functions, right? Now, what we did in the 2019 paper, we technically take a subclass of this class. So what we did, we eliminate the covariates from the density function, and we keep the covariates only in this gating function, in these probabilities. And moreover, we assume that we have a logit gating function. So these probabilities are given in this form. So that you have a logit regression, logit link function. And we were able to show that under these particular assumptions for this general class of mixture of experts, this subclass that we call the logit weighted reduced mixture of expert class still has very nice properties, has less parameters to estimate, and keeps a lot of properties that makes it ideal to be used in applications. Before going to those, to enumerate those properties, here is a visual interpretation of this mixture class distribution. So imagine that you have a portfolio, and then these are the covariates of each individual, of the highest individual. And based on these covariates, that individual will have certain probabilities pi1, pi2, pi3 to belong to one of these latent classes, latent risk classes. And once you are in a risk class, let's say class 1, you have a density F1 for your number of, for the claim sizes, or for the probability mass function for the frequency, the number of claims, and so on. And eventually, you will have this response yi that is going to be technically given by all these elements, right? Now, we have two papers in 2019. The first one, it deals with more theoretical properties of this class of distribution. So we show that it's dense. So technically, any sort of data you're dealing with, this class is justifiable to be used, in the sense that it can approximate very close any sort of data that you're dealing with. It has very nice closure properties, and like if you have missing data, for example, if you have missing covariates, the response variable without seeing all the covariates will still be in the same class of distribution. So they will be very easy to be used. Its identifiability, there are some small conditions that should be satisfied for this class of distribution to be identifiable. It's more or less like all the mixture distribution classes. Then what we were able to do, we were able to derive an ECM algorithm, expectation conditional maximization algorithm, which is very efficient, and we estimate the parameters. And we have a few papers. One is doing an analysis on modeling losses for automobile insurance, and not only losses, but also claim frequencies. And we're doing an analysis of a multivariate. So we have different, we have an insurance company that have different lines of business, and we try to model the frequencies, also the number of claims in different lines of business using this multivariate, well, the discrete subclass of this logit reduced mixture of experts. And also we're using it in modeling claim reserving, like we use a micro level claim reserving setup, and we showed that this class is actually extremely useful and produces very, very accurate claim reserves. And finally, we have some papers for this class of distributions that where they are both in R and in Julia. Like Spark, one of our PhD students, developed some software packages that can be used. There are links on our website to them, so you can freely use them and play with them, and try to maybe add your input to those packages. So with respect to these implementation features, what we have in the packages, we can we have a wider coverage of frequency and severity distribution. So when we're trying to model, let's say, frequency distributions, we have to decide what sort of expert functions we are going to use for the densities in the experts. If you have continuous responses like claim losses, we have to pick up what is the distribution of the experts coming from a continuous family of classes. And so there are a lot of packages that are using different discrete or continuous distributions. We have also dealing with censoring and truncation, which is a very important problem that occurs extensively in insurance, in both rate making and also in claim reserving. So we have packages that deal with this LRMOE class with censored and truncated data. And we have some functions that show how to calculate premiums and also reserve functions to calculate claim reserves. And we have a lot of model selection and visualization tools. So this is just a short summary of some of the things that these statistical software packages have, and they are open for people to use. Now, let's move slowly to the applications that I'm trying to present today, and I'll try to explain to you why this class of just simple logit weighted reduced mixture of experts cannot really be directly, or is not really justifiable from an academic point of view to be used for this type of problem. So one of the problems that this insurance company that we collaborated with is facing is the so-called risk sharing pool problem. So there is a facility association that takes technically different insurance companies from provinces in Canada and ask them to dump into that pool the most riskiest 5% clients, right? And all those claims are covered from a different fund, right? So to an insurance company, the question that the insurance company has to solve is that which are the most dangerous 5% of the clients, right? Now, the company that we're working with has data from 2014 to 2019, so 6 years of data. And we're talking about body injury claim history, and we have 75,000, approximately 76K policyholders that have different span of observations. So we have policyholders having 1 year of experience, 2 years, all the way to 6 years of experiences. In total, I think there are like 330 observations, so 75,000 of them, they are unique policyholders that are observed on different time spans. And we have some covariate information. Actually, there are a lot of covariates, and the insurance company selected the most important ones that are most accurate in terms of prediction: gender, driver age, vehicle price, collision rating group. So this is a way that they have their own system of defining a collision rating. That is probably the most important one, and then where the vehicle is driven in urban or rural areas. Here I have a plot. So we try to plot based on the policy year. So we have from 2014 to 2019, the log of the aggregate losses for each policyholder. So as you can see, the data exhibits, this is the log. So it's a long tail distribution, and it exhibits a complicated behavior. Some of the data are multi-module. And one thing that you can see if you look at this graph is that the data in 2019 shifts. So this is not like the most common assumption that people are making in P&Cs, that the claim sizes do not change. The distribution of the claim sizes or claim frequency does not necessarily change from time to time. Whereas here you see that this distribution, especially in 2019, shifts a little bit to the right, and it's taller, right? So for simplicity, we will assume that the claim sizes are going to be time independent. And right now we're like trying to work on extending that assumptions and making that to be time dependent in order to be able to accommodate more complicated data sets that in reality people are dealing with, right? So we assume that we have a homogeneous loss distribution during those 6 years. Now, to tackle this problem, the insurance companies are usually trying to either model mathematically this problem and try to select these policyholders who are the most dangerous ones using, let's say, modeling the losses using a GLM model. And what people observe is that the GLM doesn't really work very well, and perhaps the claim history is not linear necessarily. So there are a lot of reasons of why the GLM may not work in reality. And another quite striking observation is that the underwriting people can actually select, using no mathematical model, the most dangerous policyholder using their experience. So this is obviously something that strikes people, right? Like with the free eye, you are able to actually detect with pretty high accuracy and a much higher accuracy that a mathematical model can give you to select those 5% most dangerous drivers, right? So our initial thought is, okay, let's try to use this class of distributions, the logit-reduced mixture of expert distributions, to see if we can model the aggregate claims for these policyholders. Now, the first problem that we're facing here is that we cannot, using just that class of distributions, we cannot make distinction between different years observed for the same policyholder. So if, let's say, a policyholder has 3 years of experience, we have to treat that policyholder as 3 different independent policyholders. So we cannot keep track of the past experience of the policyholder if we use a GLM or if you use this more general mixture of expert model. However, what we did, we tried to fit on the entire data set, with assuming again that each year is viewed as a different policyholder. We try to fit the model, this logit-reduced mixture of experts. And we have a prior classification for each policyholder based on their covariance to belong to some of these latent states of the model. And then based on the experience at the end of each year, we try to a posteriori change this probability, these gating functions to belong to one of these latent classes. So one can actually recalculate posteriorly the probability to belong to one of those classes and technically reassign those, let's say, safer policyholder that have claims with different probabilities to perhaps more dangerous classes, right? However, these assumptions that each policyholder, like each observation each year, is independent from each other is extremely strong and obviously unrealistic. And one has to be able to, in order to have a more accurate prediction on either the claim severity or the claim frequency, has to observe more data in the past. However, these type of mixture models do not take into consideration on the time dependence, right, in the model. I have 2 graphs here to show you how we did. So first, we tried to use the GLM model to model the claim severity, and I think we're using a logistic regression for number of claims. It's a zero inflated data set. There are a lot of policyholders, as usual in insurance, that have 0 claims. So we use a logistic regression for the probability of having 0 or more than 0 claims, and we use a log normal distribution for the claim sizes. And we feed the model like every 6 months. And what you see here is we're taking out those 5% of the policyholders using the GLM model. We take out the 5% of the most dangerous policyholder based on the GLM prediction. And the blue lines are those that the model, the GLM, takes out. And the red ones are those that we actually see within those 6 years that face the bigger claim. So ideally, if the model will work well, the GLM will identify these models will be in the same, they'll be the same, like in a mirror, right? So you can see clearly that the GLM model does not predict well those most dangerous, 5% dangerous policyholders. Then what we did, we tried to, instead of fitting the GLM, we feed this our LRMOE model. And you can see that the LRMOE model does a much better job in catching up the risky policyholder, right? However, as I said, this LRMOE prior assumption is not really, like, by modeling every observation per year as independent from year to year and not changing the policyholder covariates and not taking care of the history of each policyholder is not really mathematically well justified. So one wants to perhaps improve these modeling assumptions and come up with a model that in fact keeps track of the past of each policyholder in a proper manner, right? So despite the fact that the LRMOE works well, is not really well justified, at least theoretically, to be used to tackle this particular problem. So the next step that we are going to propose is to actually extend this class of logit-reduced mixture of expert by including random effects. And by including random effects, we will be able, like if we assume, as you will see, a one level random effect for each policyholder, and then the number of sub-levels will correspond to the number of policyholders we have, we will be able to track the past of the claim history of each policyholder. And we will be able to a posteriori classify the policyholder based on their entire time history. Like here is the posterior risk classification under the LRMOE model, which the formula is correct, but the assumptions that we use are not. So therefore, using this formula is erroneous, at least from a theoretical point of view. So what we will be doing, we're going to use random effects, and the Spark and Samson, in fact, created a very general class of distributions considering L different level of random effects with sub levels random effects. So you have a hierarchical type model, and they prove some of the like same type of properties like denseness, identifiability, closure for this class as well. However, for our particular problem, we'll not need the entire generality of that class. We'll need just one random level for the random effect. So let's assume that we have n sub 0 unique policyholders, and this is a multi-year insurance portfolio. So we have n small contracts, right? So some of these policyholders are going to be observed for different periods. So here is just a simple example with a policyholder that is observed for 3 different years. So you have the covariates x1, x2, x3. They are changing from year to year, obviously. Obviously, that the from year to year change may not be significant, but some of the covariance, like if the drivers moves in different areas that are less risky to drive in, those covariate influence is going to be significant. And for each of the covariate, we're going to assume that you have a random effect. So you have a random variable that tracks the history of each policyholder. So this W is going to model the unobservable risk of the policyholder. So like in credibility, if you want, you have a model distribution, you model the losses given some unobservable risk, and that unobservable risk is going to potentially change from year to year. So in general, this class of mixed LRMOE may assume L different levels of for the random effects, and each of these L capital levels, let's call it L small, may have SL factors, right? So technically, we're going to, well, the model that we initially proposed is a very general model. Now, to see the way that we're going to incorporate the random effects into this mixture of X-plus models, the same way that we have for the covariates. So if you remember, in the gating function, the covariates are going to tell you which are the probabilities to belong to one of those latent RISC classes, right? We're going to add on top of those covariates, we're going to add the random effects there in the gating functions. And those together now, the classical covariates and these unobservable risks are going to give you the probabilities for each policyholder to belong to one of those latent risk classes. And then again, assuming that you know where you are, you may have different densities or probability mass functions for whatever random variable you're trying to, like your response is going to be. The distributions and the density functions of these random effect omega will be, like, we assume that they are independent within each level and within each sub-level. So these are the multivariate CDF and PDF for the random effects. And as I said, in the pi functions, we're going to, like previously, the pi function was just this logit regression model that contains the effect of the covariates. Now we're going to we add to that the random effects here, right? Multiplied by some weights, betas that we have to estimate from the data. Now, the likelihood function of such a model is you multiply by all policyholders, and you have the multivariate density of these more general class of mixed LRMOE. Now, Samson and Spark, they prove in one theoretical paper that this class still has the same very strong properties. It's still dense in uniform convergence, and so it's flexible enough to capture different dependence types without imposing any sort of regression. This class being dense, you technically can cover any sort of regression patterns. You can accommodate for random intercept or random slopes, and this is the flexibility of these, like this justify the flexibility of the class. And then later on in this paper that we publish in the Journal of Risk and Insurance, we show how important this class is to model this temporal dependence. So how the history of each policyholder will be actually taken into consideration, and how important is to make the distinction and like look at the entire past data for the policyholder rather than ignoring the dependence from year to year. And you'll see this in some examples. Now, very briefly, without getting into details, the calibration method that we use for this particular class of random effect models, we use the variational posterior, the variational inference method that is used apparently in machine learning. I'm not an expert by any means, but the whole idea is that when you try to calculate the true posterior distribution, right, when you try to calculate the posterior distribution of your unobservable risk given whatever data you observe in the past, this is analytically is very complicated, right? You have to integrate the model and the prior, and it's very complicated to be calculated exactly. And whenever you try to, let's say, calculate the premiums, you have to integrate like the random effect, right? So you have to be able to have the form of this posterior density. And what the variational inference model says is that it tries to, instead of using the true posterior, which is given in this form, where again phi of omega represents the prior distribution of the random effect, where you're going to assume you're going to assume that this distribution is actually coming from another distribution whose parameters here mu and sigma, we will assume that is a multivariate distribution, a multivariate normal distribution with parameter mu and sigma that are independent either on the observations, like on the y's, and the covariance. So technically, the whole idea of the variational inference is to replace the true posterior by another distribution that whose parameters are not dependent on y. And instead of, if this is the likelihood function, the marginal likelihood where the random effects are all integrated, instead of maximizing the likelihood function for the true likelihood function, you will maximize the lower bound of the likelihood function. And the lower bound, one can easily show that the lower bound of this function is the expectation with respect to this variational posterior, the one that we assume will approximate well enough our true posterior of this expression. And the KL is the KL divergence measure that measures the divergence between the Q being the variational posterior and phi being the origin, the prior distribution of that. However, this type of variational inference algorithm is not very well researched. So there are a lot of open problems, like we don't know how close the lower bound is to the exact distribution. So you have a lot of problems of convergence, speed of convergence, and if it converges to the right distribution, and so on. So these are open research problems in machine learning and in statistics. However, this type of variational inference algorithm is worked pretty well for our data, and it's very effective for large data sets, and it's very computationally tractable. And what we have to do, like the calibration method that we're using is in fact much more complicated, because you have an EM algorithm. Remember, you have those latent states, so you have to augment your unobservable data with the complete data for all the latent states, and you have to combine that EM with this variational inference, and you have to estimate the parameters in, there are a lot of steps that are have to be used in that estimation procedure. And I'm not going to enter into those, but you can read the papers if you're interested in that. So now let's go to the application of this data set and this model to the data set, and what we're going to compare this with. So we'll try to model so we have these 6 years of observations from 2014 to 2020, and here there is a typo. So we have a test set from 2014 to 2018, and we're going to use the year 2018 and 2019 to, the training set is from 2014 to 2018, and we have 2 years of testing set the last 2 years. Now, because we have to predict claims based on previous history, we're going to eliminate from the data set all the policyholders that have only 1 or 2 years of experience. So we're going to fit policyholders with 3 or more years of experience, 3 to 6 years of experience. And if we have, let's say, 6 years of experience, we leave the 5 years of experience to train the data and leave the last year to test the data. And we will be using 4 different benchmarks. The first one is going to be GLM. So we're going to use a logistic regression on the probability of having a claim or 0 claims or more than 0 claims. And we're going to fit the claim amount using a Gaussian GLM for the log claim. So it's a log norm, right? Then the next 2 models that are going to be used as benchmarks, we're going to use GLM-M in either the logistic regression with GLM in the severity distribution, or GLM in the logistic for the logistic, like logistic not with mixed effects, and GLM-M for the claim sizes. So we'll have a combination of those 2. And we also use the LRMOE distribution that, again, does not keep track of the history, and we use a 0 inflated log normal expert. And also our the newly proposed mixed effect LRMOE. And we use the 0 inflated log normal expert, and we're going to have a single level of random effect, and each of the policyholder will have a random effect for each one. So these unobservable risks will be different from policyholder to policyholder. Now, this is a goodness of fit graph where we present, so the blue is the data, the real data, and then we have the GLMM, and again, we model the number, the logistic, the probability to have 0 or more than 0 claims. And the second part tells you what is the claim size distribution, what model we use for the claim size distribution. So you use GLMM, LRMOE, or mixed LRMOE. And as one can expect, when the GLM is used, the modes are not like, it's not a multimodal. Like in this case, you see there are multimodal distributions. So the GLM and GLMM does not work very well. The best fit we have, and catches better this mode as well, is the mixed LRMOE. And this is on the training set, and this is on the test set. Now, the test set, as you can see, is not fitted very well. Our distributions are a little bit shifted to the left. And the main reason is, again, if you remember the data in 2019, which is the test set, it's shifted to the right. So because our training set does not exhibit the same behavior, and we assume that we have the same distribution, is time independent, the claim sizes are having the same distribution over all years, then we're not going to capture, obviously, a data that is very heterogeneous, right? So in order to improve the model, the next step in research will be to assume that the claim sizes actually are time dependent, so they change from year to year. Here are some goodness of fit. So we have the GLMM, GLM, as I said, the very different variations for the logistic, the probability of having 0 or more claims, and the claim sizes, and GLMM. All of them are doing more or less the same. Obviously, the GLMM will be the best one. These are the number of parameters. We are using the training and the testing set. You have the log likelihood, and we use the AIC. And the mixed LRMOE model, compared to LRMOE and compared to these benchmarks, the mixed one performs the best. So what we do is we have to select the number of parameters, the number of components in the mixture, and we use the AIC. And the way that we create a validation set, which we randomly select from the training set 20% of the observation and pick up the one that gives the smallest AIC. And that in both LRMOE and mixed LRMOE will come up with 5 components. We have 5 different RISC classes. I don't have the time to interpret and show you the probabilities, but clearly each of these RISC classes will actually correspond to small claims, average claims, and all the way to very big, large claims. So the model is pretty interpretable. Obviously, we'll have more parameters, but as I said, the variational inference algorithm works very well and very fast. And we did some simulations where we started with the distribution that we propose, and we use, technically we started with a mixture distribution, and we start with some initial parameters, and we recover the distribution. So these results are in the paper. Okay. Now here I have a graph which tells you, so on the training set, we look at the whole policy holders that we have in the training set, and we identify those that have 0 claims and those that have 1 or more claims. So the blue ones will have no claim history, and the red ones will have at least 1 claim history. And what we did here, we calculate the posterior probability of those policy holders. So technically, we try to find what is the premium that I have to charge, or what is the expected claims, right, which is the premium that I need to charge for classes that have, for policyholder that have 0 claims, and for policyholder that have at least 1 claim. And so the blue histogram represents those that have 0 claims. The red one, which is shifted to the right, obviously you have to charge higher premiums for those posteriorly, for those that have claims. The red one shows the shift to the right. Now, the shift is much better captured for the models that contains mixed random effects, right? You see the GLM and the LRMOE, they don't make a huge distinction between policyholder that have 0 claims in the first, whatever training period is, first 5 years, and posterior probability. The posterior probability doesn't really capture the past information about the claims. You will charge more or less the same amount for those that have 0 claims to those that have 1 or more than 1 claims. Whereas the ones that penalize more the model are those that contain that considers random effects. So you can see that the GLMM is the shift between the price that should be charged for those that have more claims, more than one claims, or one or more than one claims, it's more shifted to the right. And the mixed LRMOE model also catches that, and it penalizes even more, right? Here you have the same kind of analysis where the same thing, you are calculating some predictive means based on different models, based on a policyholder that have, it's an average overall policyholder, I think, based on no claim policyholder and at least one claim policyholder, right? So you see that the premium, the increase in premium between 0 and at least one claim is just 21% if you assume a GLM, whereas if you assume just the LRMOE, there is almost the same premium that's going to be charged. Even if you have a claim, you'll still be charged the same amount. Whereas the mixed LRMOE and obviously the other random effect model, the GLMM, will also catch the premium that is going to be charged will be significantly higher. And what you can see, the mixed LRMOE is going to have a smaller premium for those who have 0 claims. So it's going to give an incentive to those that have a good claim history, and it's going to charge more drastically those that have a higher premium, that have at least a claim. And yeah, I'm not going to explain the remaining part. And here we have 2 different combinations of policyholders. We took 6 policyholders, A1 and A2. They have the same covariates, but one has 0 claims in the training period. The other one have a claim or some claims that add up to 850. Another pair of policyholders from a different with different covariates from A, but the same covariance between B1 and B2, and similar for C1 and C2. So within each of these A, B, and C, they have the same covariance, but they have different, like 0 claims, B1, C1, A1, and the A2, B2, and C2, they have $850 claims, $1,950, and $5,704. So you can see here that if you use this GLMM, technically, the model does not penalize that much those that have claims. We actually, if we use the mixed random, LRMOE, the mixed effect LRMOE model, you have a reduction in the price that you charge customer A1 that has 0 claims, and this one is going to be penalized less. And you have here something that you may interpret as an anomaly. Let's say this policyholder have only has a claim of $1,950 compared to a much higher claim exhibited by the second policyholder. However, if you take the differences, the absolute differences between how much you penalize someone that has 0 claims versus how much you penalize this, you see that this guy, you expect that this guy that has almost 3 times higher claim than the previous, than B2, will be penalized more, right? In fact, what is very important too is the covariate of policyholder B. So the policyholder B actually has one of the covariates. He has his risk classification according to the insurance company much higher than C. So in that case, that particular covariate that is well known actually somehow plays a bigger factor than the amount of claim that that policyholder faced in that training period. So I'm almost finished, and I know that I'm almost exhausting the time. So the conclusions, and well, we have to, there's ongoing work on this. We have to take into consideration economic and business implications on using this class of distribution. So clearly the mixed LRMOE is much more aggressive. So it penalizes harsher the policyholders, right? The long-term changes in the composition of the insurance portfolios may be as follows. Like if you have a policyholder that has like a bad claim history, you may decide not to renew that, right? So you may eliminate the risk for the portfolio in a harsher way that you eliminate if you use the classical GLMM model, right? You may get a decrease in the premium income as a consequence of eliminating this much drastically, but you may have a higher profit. However, you may face different challenges, potential challenges, and the two of them that we can view here is that you have to communicate the revised premium to both policyholder and stakeholders. So because your model penalizes harder, there might be some consequences that the stakeholders do not want to lose some of the policyholders, as well as you may have legal and regularity implications like fairness and stuff that should be imposed in order to so that should be taken into consideration when you penalize so when you use a certain model. So because this model penalizes harsher, you may not be able to use it for these two type of legal or regularity reasons. So we extended this flexible regression model by adding random effects. We obtain we proposed a variationally inferred method to calibrate the model, and that is computationally very tractable. And we are able to obtain posterior rate making in a more justifiable way. However, as I said, there are open problems that one has to consider when using this model in terms of not only profitability, but legal and other consequences that may influence the use of the model. Here are the papers that we used for this type of research, starting from the LRMOE papers in 2019 all the way to this paper that was published in the Journal of Risk and Insurance, which is cited in the first. So I'll stop here and thank you very much, and I would be happy to answer questions.
Thank you so much, Andrei. Do we have any questions from the audience? You can put them in the chat as well, and we can read it out for you.
Then maybe I'll use the 2 minutes that are left to ask 2 questions.
Yeah.
Maybe others will catch up. Andrei, super interesting. Thank you very much. I have a question about the denseness that you mentioned. When it looks like it's connected to a mixture of exponentials, how do you get the denseness?
That's good. So yes, there are certain regularity conditions. Like I'm not going to talk about the random class, the random effect, the mixed effects class, but going back to the LRMOE class, you have to be careful how you choose so you have the gating function and you have the experts, right? There are certain regularity conditions that should be satisfied by the experts functions in order to make the class dense. So if you pick up exponentials, you are not going to satisfy those regularity conditions. So the regularity condition is saying that for certain values of the parameters, your continuous experts should converge to a degenerate distribution. If you have that type of property, then your mixture of expert is going to be dense. But as you said, experts that are exponentials are not going to be making this class dense. However, Erlang will make it, and other like gamma and other type of experts that possess that regularity condition will make that class dense. So this is a great question. Yes, you can still use it, right? You can still use exponentials, but then you will not have that theoretical property. However, if the data exhibits lighter tail or so, then you can use an exponential distribution.
I see. Thank you. And then a follow-up, because I was thinking about the Erlang, in fact, and Sheldon's papers about mixture of Erlangs.
Yeah.
So the denseness there, let's say that I'm going over Erlang, probably depends on the choice of G, correct?
The number of components?
That's right.
Yeah, no, I don't think so. Like is it an infinite mixture?
I think, but based on my memory of what happens when you do this finite mixture type of thing, I mean, think of matrix exponentials, for example.
Right.
What you have to have is that the convergence is for when you actually increase the number of components, which in your language would probably increase the number of the G value. But then I assume that mostly the G value is not really high because it corresponds to the number of RISC classes.
I do not, to be honest, I don't know very well, but I think the finite mixture of Erlangs is also dense. So I don't think you have to have an infinite mixture in order to assure the denseness property. But I may be wrong about that.
Interesting.
However, for this, we do not need to assume that you have an infinite mixture.
Interesting. Okay, I'll check that because I think that you do. But okay, never mind. Maybe I'm wrong. Thank you anyway.
Yeah.
Any other questions? No? Nothing in the chat as well. Well, Andrei, thank you so much for your time and for the very, very valuable presentation. We really appreciate it. We hope to see you next time on campus for another
Thanks,
presentation.
Anani. Thanks. It was a pleasure. Yeah, I hope the same.
Till the better times, right?
Absolutely. And yeah, Ed, I'm happy to talk about it. For this class, we don't need a finite. We don't need your component to be an infinite mixture.
That's quite great. Thank you.
Yeah.
Thank you.